Today is November 13th, 2023, and this is your Monday Market Update. Last week was supposed to be a quiet week, but as we discussed, rarely does that happen these days. Let's do a review of the fireworks from last week, and let's preview the upcoming week. While the news is still fresh, note that this is being recorded Monday morning. As of now, the big question of the week, and we'll get to that in a bit more in a second, is will the government shut down? Also, the two big eco data points, CPI and PPI. Good short-term news. The shutdown will not affect this week's eco data. Deadline is Friday, so all government eco data after that is at risk, so we'll see how that goes. Let's get back to last week first. Stocks gapped higher on Monday as momentum and the lack of escalation in the Middle East was digested by the markets. Markets did ignore rising Treasury yields, Fed heads speak about higher rates, ECB and BOE comments about higher for longer, and even the important but not watched too often Senior Loan Officer Opinion Survey. Overall, there was not a lot of power to keep the markets up, so as the markets bounced around, it finished up, but not big. Dow up slightly, S&P up less than 1/4%, and the NASDAQ up 1/3 of 1%. One of the headwinds started to show its head again Monday with the 10-year rates moving higher. As I've been talking about lately, the Treasury has a supply-demand problem, or at least it seems that way. Recall that the market liked the amount last week, a bit less than the U.S. Treasury is coming to market with than expected. Before you think this is a significant decline, we're still talking about $112 billion last week, $760 billion this quarter, and $860 billion in Q1 of 2024. All of this as the three biggest buyers, China, Japan, and the U.S. Fed, have become net sellers. So as we saw in the past weeks, if there is no demand, rates go up, and that is a headwind to stocks. Keep an eye on this. We've been talking about it over the past few months. Treasury auctions can and have turned the markets intraday. Monday also had the fabulous WeWork that almost went public in 2019 as a $47 billion company. Filing for Chapter 11 bankruptcy is just another lesson in market history. Quick review of the calendar and what it has meant in the past, not for sure in the future, but let's take a look. We are less than a year from the 2024 election. Based on the past, it may be good for the market. Fourth year of presidential term has not been particularly strong, but year 3 is the strongest. Average gain of nearly 17%, but election years when the president is running for re-election, like this one, have been good. All 15 times that has happened since 1952. The S&P has gone up. We'll see if the split Congress and budget constraints can change this. Stay tuned for more on this. One more historical for you today. October was the 39th 3-month losing streak since World War II. The month after that has been positive 61% of the time. So let's see how that goes. Markets open pretty flat on Tuesday. More digestion of the news, this time central bank noise, disappointing eco data from overseas, and on the positive front, inflation gauge dropped a bit. We did get the New York Fed household credit report, and it's a good thing they don't measure the credit usage of the U.S. government, but for households, credit usage is up another $48 billion in Q3, up to $1.08 trillion now. Delinquencies rose by 3%, a data point that is being watched closely. More Fed heads pushed back on the market's expectation, but that was no match. S&P closed up about 1/4%, best since September 20th. The Dow was up a little under 1/4%, and the Nasdaq was up. The Nasdaq was up almost 1%. The market is getting an earful, just to be sure that markets remember that the Fed will not hesitate to raise rates more if necessary, even though it's pretty obvious that bar is pretty high. Wednesday saw stocks open with a slight gain. Eco data was supportive. The speakers, ECB and Bank of America's Moynihan, not all too positive. Powell was slated for a 2 p.m. Eastern. He did end up saying not too much notable. As I just mentioned, the 10-year auction was good for bond bulls, lower yield. Disney earnings after the close, and for a bunch of reasons, markets approved of it. Not everyone agreed, and you know who you are. The Dow broke the win streak and was down slightly. S&P and Nasdaq eked out gains, both just barely. Earnings season is pretty much over, and it was not as bad as feared. See how I did that? As of early in the week, 90% of the S&P 500 companies have reported. 82% beat expectation. That's above the 74% that's the 10-year average. Maybe the bar was lowered a little bit too much. 4.4% year-over-year gain. That is the first positive quarter of year-over-year gain earnings growth since Q3 of 2022. More to come on that in the next few days, but it was a mixed bag. The good news is that overall the numbers did not cause 2024 S&P earnings estimates to decline. Let's just put some thoughts on the radar. Just in case the rose-colored glasses return to the news, which I'm seeing a lot of, I just want to add some balance. This is not all bad, and there is a lot of good. Just note, first, there's a lot of anecdotal evidence that consumer spending may be slowing. Not falling off a cliff, just slowing. Also, big ticket item sales posted some disappointments, and that can be a sign of more pullbacks to come. Finally, for today's watch, travel demand may be easing, again, not collapsing, just hints of softening. We'll watch all of this, and I'll let you know when it turns worse or better. Big news aside from Disney earnings, also from Hollywood, tentative deal with the actors, so maybe we can get less reality TV next season. Stocks gapped higher again on Thursday, but came back down to flatline quickly as jobless numbers came in mixed, still showing a tight labor market. Catalyst, as we have spoken about, is the 30-year bond auction. That was not good, and thus stocks sold off. Powell did make some noise in his speech and was clearly hawkish. Yields spiked, stocks fell. He was clear as a Fed chair can be. They are prepared to do more with monetary policy to bring inflation down. Again, the bar is high for a hike, but the market is still starting to price in a cut. Seems less likely if you listen around. S&P and NASDAQ snapped the longest win streak in 2 years. S&P down just over 0.75%. NASDAQ was down about 1%. And the Dow was down about 2/3%. Stocks opened higher on Friday after the first long losing session in 9 days. The big news of the day was the University of Michigan survey. Sentiment was lower than expected, and inflation expectations keep going up, not down. In fact, the expectations are the highest since 2011. Stocks basically ignored all that data and ignored the risk off from Thursday and off to the races. Dow was up nearly 1.25% for the day. S&P up 1.5%. The NASDAQ had the best day since May, up over 2%. For the week, the Dow was up 0.75%, S&P up about 1.25%, the NASDAQ was up 2.33%. Let's take a look at the week ahead. As little catalyst-producing data as there was last week, this week has a bunch. CPI Tuesday will be the first big one. PPI, retail sales, and Empire Manufacturing on Wednesday. Then we'll slide into the end of the week with the weekly jobless claims. We'll get Home Depot, Target, and Walmart during the week leading into the holiday season, and what they say will matter. This will be a week to watch, though it seems like every week these days is a week to watch. In no particular order, as I just said, the eco data and the retail data. Add to that the downgrade of U.S. debt over the weekend. It will be downplayed, but Moody's kept the AAA rating, but cut the outlook to negative, really saying that the debt is less appealing to buyers due to the risks of the U.S. system and the national debt. By the way, $50 trillion is the national debt estimate by the Bank of America by 2033, just 10 years from now. That leads to the next big item on the list. That is a dysfunction in Washington. Shutdown watch is on again. There should be a deal or another continuing resolution by the end of the week, or we'll have a shutdown. Goldman Sachs went into some detail on this, and a shutdown is not their base case. The key thing to watch is that if they do not come to an agreement and only keep putting temporary Band-Aids on this, automatic spending cuts kick in May, just in the heat of the election season. One last set. Yes, you guessed it. Get out your Fed head collector cards. This week, we'll get a bunch, a bit over 1 month before the next Fed meeting, so they need to stay busy. Cook, Williams, Jefferson, Barr, Goolsbee, Mester, Waller, Collins, and Daly, and some of them are even going to get a few appearances. As you can see, another big week ahead. As always, remember that we are always seeking to reach your goals. This up and downs report is just a tool. Please keep listening to the Friday video about what needs to be done before the end of the year. It is coming soon. For now, please keep the 240 plus hostages in Gaza in your prayers and keep praying for success and peace. Have a great week.